Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we have the CEO of Bannerman Resources, Brandon Munro. How are you today, Brandon?
Really well, thanks, Karen. What about yourself?
I am doing great, thank you. Let's talk about your background in the uranium sector. You are currently the CEO of Bannerman Resources, but I want to go through part of your early career, and if you can share with us any experiences of the previous uranium bull market and what that was like for you. The run-ups in the stock prices for a lot of small juniors was a fantastic period for investors who got in early and got out just in time. So give us a sense of what it was like to be a speculator in that market back then.
Well, my transition into the uranium sector is probably a little bit more unconventional than most. My background, I first of all studied economics at university and then moved on to study a law degree, and ended up through that path as a mergers and acquisitions lawyer working in Perth, Western Australia. And as I'm sure your listeners would know, Perth is one of the great resource centres of the world, and in particular, an active speculative stock market here. And for that reason, the boom in the uranium sector starting in 2005 was quite acutely focused in Perth. And I remember it was a great time. I vividly recall conversations amongst my social circles in the early 2000s. And one of the great topics was, well, when did you get into Paladin? And I think Paladin commenced 2005 at 4 cents. And so there were bragging rights for people who got in at 4. And when we had one of those conversations, Paladin was, oh my goodness, 12 cents already. And so as you're well aware, that was really quite an incredible ride. And even in the course of 2005, the Paladin share price moved from 4 cents all the way up to $2. So uranium was very much the talk of the town back then. And it's interesting to then look back at many of the similarities between where we stand today and 2005. So 2005 was the first deficit year in many years. They had a £19 million deficit back in 2005. And of course, we finished 2018 with about a £30 million deficit, with £40 million projected as a deficit for 2019. So, of course, in 2005, we had MacArthur River flooding, but the difference is it was only 3 months back then, where, of course, now we've had a permanent shutdown. And there was a lot of talk, the trajectory of uncontracted uranium demand amongst the utilities was very similar. There was a lot of talk about China's as yet unrealised ambitions in nuclear, et cetera, et cetera. And so other than being a stock market investor and having uranium stocks as one of the most popular conversation topics back then, as an M&A lawyer, I was obviously exposed to the sector and the quite extraordinary deals that were done during that time. So, for example, the specialist firm that I was at, we represented Summit Resources. We were their defence team in the excellent result that they obtained. At the beginning of 2005, Summit had a share price of 16 cents. And by the time Paladin had completed the acquisition in April 2007, they were worth $6.22 a share, which valued the company at $1.2 billion. So that was a wild ride. That was intensely informative for me as to just how much leverage uranium stocks can have when they're a fairly small but important cog in a very, very large industry, which is that of nuclear power.
Let's go through your analysis on the current spot price for uranium today. Investors were happy to see the spot price rise to nearly $30 per pound, and since then it has been consolidating within that area. So what does this initial rise signal to you, Brandon? As someone who has a deep knowledge of the uranium sector itself, was this simply a bounce off the lows, or is there something more substantial taking place behind the scenes?
Well, the first thing I'd say is we are in a very, very low price environment. So without being flippant about these prices, it's easy to say that whether it's $30 or $20 or $35 or $19 as it was not long ago, it's all essentially irrelevant because it's so far below the average cost curve of the industry, and there's such a large proportion of uranium production around the globe that is well in excess of these numbers. But as I say, I don't want to be flippant about that. because the important factor is, I think what we've seen is well and truly a bottoming of the market. So if we look at what happened in 2018, we had prices increase about 30% from their lows in April. And that was driven not by speculation, not by the normal ebbs and flows of a supply and demand picture, but that was built upon by the substantial supply disruption that we had, in particular the temporary closure of MacArthur River. So where we find ourselves now is a price that's been bobbing around a bit below $30. The most important factor around that at the moment is the Section 232 trade investigation that's being conducted in the US. And any of your listeners who follow the uranium sector, I'm sure, are well familiar with that. It seems to be getting most of the discussion time in the sector right now. What it's done, though, is because this is a trade investigation that is almost ready for conclusion, the final decision needs to be made no later than mid-July this year. Because of that factor, it's very much suppressed the normal market activity that we see in this sector. And the activity that's coming from utilities in the form of both spot market buying and long-term contracting has been largely paralysed. And you can understand why, because utilities hate uncertainty. There's a number of outcomes from Section 232 that are unpredictable. And so the utilities, their view by and large is, well, why would we execute a procurement strategy now when we are relatively around the corner from having that level of uncertainty? And it's in that context that we're seeing the market soften and we're seeing the uranium price drift. And it's also adding credence to a very interesting psychological phenomenon that we've seen emerge in the uranium sector, which is the concept of the $30 psychological barrier. The barrier, I think, first came about because $30 was seen as a trigger point for large generalist funds to start putting money into some of the specialist uranium investors that have popped up over the last 12 months. But it went from having airplay just really inside financial circles towards the end of last year to starting to gain some credibility when we saw prices on a rapid increase from $21 to $29 and then pull back. And as I said, they're hanging just below that $30. And the narrative, quite interestingly, is that once this $30 price barrier is breached, for various reasons, which I've got some credibility behind them, for various reasons it will then run quite quickly to 35 and likely beyond as that event dovetails into other things in the sector. So interestingly, we've started to hear that narrative not only from the financial guys, not only from the traders, but even a number of uranium producers and utilities have discussed that with me in the various meetings that I've had this year. So where we look today, we are below that $30. There's a number of catalysts that I think are coming up, not the least of which is the resolution of Section 232. And from there, hopefully we'll see the price quite quickly move out of this unsustainably low position and start to reach a position where we have a genuine sense of balance in the market.
Brandon, you mentioned briefly before the supply disruption going forward for uranium. So let's go into a few more details about this. You gave a presentation that outlined some of the highlights regarding this and what it may mean for future higher uranium prices. I know last summer you made some predictions concerning this, and towards the end of last year, your calls were pretty spot on. So can you talk about this?
Yeah, so the biggest factor was this supply disruption. And it's in the context where we've had almost a decade of surplus production in the uranium sector. It came about largely because of Fukushima events, which many people are surprised to know was 8 years ago. But what Fukushima did was it caused a number of reactors, predominantly in Japan and Germany, to turn off prematurely and to go offline. And that punched about a 10% demand hole in the uranium picture. But because so many long-term contracts had been written in the sector during the last boom and in the lead up to Fukushima, all of the producers were well protected by that contract pricing. So we didn't see the 10% pullback in supply that was really needed. And that supply overhang continued for a number of years, which propagated this decade-long surplus and saw a long-term bear market extending all the way into where we found ourselves towards the second half of last year, when I think prices have finally bottomed. So it was a failure of the market to respond to that demand decay that we saw immediately after Fukushima that has lengthened the bear market. But what it has also done is it's forced a number of producers either out of business or forced them to suspend production. So the most significant of that, of course, is McArthur River, the largest uranium mine in the world, which is the flagship asset of Cameco, listed on in North America. And that was initially put into a 10-month temporary suspension, which was then extended indefinitely. So that took a large proportion of the market out. That had a capacity of, in recent years, 18 million pounds. It was doing 15 to 16 million pounds in the years before it was turned off. And that's in the context of a net consumption across the sector of about 170 million pounds. So a big bite out of the supply. So if we compare it to 2017, when there was some surplus of production over that calculated net consumption number, we've had McArthur River with that reduction of 15, 16 million pounds. Langer Heinrich, a long-running mine in Namibia, has gone on to care and maintenance as well. They've got a full production capability of 6 million pounds. We've had a number of reductions in the US. We've had reductions in Niger. And we've had Kazatomprom, the world's largest uranium producer out of Kazakhstan, also significantly reduce their production. So there's been this primary reduction in supply that's then been exacerbated by the reduction in a couple of secondary supply sources. So last year we saw the US Department of Energy suspend a program that saw them tipping about 5 million pounds into the market to fund a Cold War cleanup. But the factor that's really exacerbated all of those supply effects is the emergence of physical fund buying again into this sector. So 12 months ago, we had UPC, Uranium Participation Corp, in Toronto, and they were the only uranium buyer, in other words, investment vehicle that buys and holds uranium and other uranium derivatives such as US6. In June last year, we saw the announcement by Yellowcake PLC that they would be raising about $200 million and listing in London. And that's been a game changer for the sector. Not only have they bought 9 million pounds off Kazatomprom, which has further exacerbated that supply deficit, but they've also got a very interesting option where they can purchase another $100 million per year of uranium from Kazatomprom for the next 9 years. So all of those supply disruptions added up come to about 35 million pounds, or 20% of the market, which took the sector from about a 5 million pound supply surplus in 2017 to about a 30 million pound deficit in 2018. And because of demand growth, we expect that that deficit's likely to top 40 million pounds in 2019. As a percentage of the market, that's just extraordinary and exceptional. And if you imagine what would happen in zinc or copper or another more broadly traded commodity, it'd obviously have a dramatic price effect. Interestingly, we haven't seen that yet in uranium, and that's largely because of the Section 232 action that I've described, and also the fact that utilities and others were able to build up a reasonable additional excess supply of inventory during those periods since Fukushima. And it's that inventory that so far had a suppressing effect on the price.
So going forward, Brandon, what would you say are perhaps the most critical risks for a new bull market in uranium to be halted or even delayed? Or is this time around, are there simply too many positive catalysts on the horizon to potentially derail a bull market for the sector?
Well, I'm glad to hear you asking that, because a lot of the time when I'm talking to investors, they're singularly focused on upside. And it's vitally important that, certainly from a producer's perspective, but also from an investor's perspective, you are constantly asking yourself the question, where could this be wrong or where could this go wrong? But if you start running through the list of potential candidates to end this bull market, it gives me a huge sense of confidence. So the first one that's always prevalent in the nuclear industry is another event, another accident. We saw what an effect that had with Fukushima. The same could have been said with previous incidents, in particular Chernobyl. What I would say about that is I spend a lot of time in the nuclear sector itself. I have quite an active involvement at the World Nuclear Association. There are extraordinary lengths being taken by all of the players right across the nuclear sector on safety. And I could point to probably a dozen macro events that would have a greater effect, not only on uranium investments, but on all commodity investments that are far more likely than another nuclear accident. So it is something that you always have to have at the back in your mind, but I believe that the risk is just so low of it happening again that it's something you must react to if it happens, but it's certainly not something that should cloud an investment decision. So then you start ticking through the other factors. So technology, what technology could change? Probably the biggest ones that are talked about are laser enrichment, which is a form of alternative enrichment technology. That is back on the table now with Silex reaching a new deal with Cameco, but it's still many, many years away. And the initial, even if it is successful and it does get up and it is proven and it is funded, the initial program that's talked about with the US will be the equivalent of a modest sized mine, about £5 million per annum, which is smaller than the mine that Bannerman plans to build in Namibia, for example. So that's not going to be a game changer. And the other technology that's talked about is thorium. And I won't absorb the time that we've got now talking about that, but everyone within the industry sees that as simply a non-starter. It might have an impact around the edges, but there's just so many reasons why we don't see thorium disrupting the conventional nuclear sector anytime in the next 40 or 50 years. So then you move, well, okay, so we've looked at an accident, we've looked at technology. If you look at the major markets, so the growth story is very much driven by China, to a lesser extent India, Russia and other developing nations. So the major factor that could derail a bull market would be if China suddenly turned its back on nuclear in favour of what could only really be renewables. Now, I've long held the view that that's extremely unlikely. Whilst China has invested extraordinary sums of money and other resources in renewables and is the largest builder of renewables in the world by far, its economy and its energy requirements, particularly with the electrification of transport, are just growing at such a vast rate that to infill its growth rates with renewables is going to be a huge challenge. Nuclear will play a role and a significant role in that proportion of growth. But we have to remember that that's not what China's energy challenge is. China's energy challenge is to displace its 70% reliance on coal. And it can't replace baseload coal power with intermittent renewables. So we see a huge opportunity for nuclear to make inroads into a substantial displacement of that enormous coal energy supply to meet the absolute social imperative that China's got to clean the skies. And there has been a bit of speculation in recent times about maybe China has turned its back on nuclear, and that's been driven by the fact that since 2015 there hadn't been any new approvals of nuclear plants. Well, just in news this week, we've had the official confirmation that they've approved 4 new plants and there's many more on the way. So I think what we're seeing for sure now is the 4th batch or the 4th phase or wave of nuclear power plants being approved and built in China. So then when I look at the market factors with such a strong driver, I can't possibly see how market factors are going to disrupt this bull market. So hence why I've got a very high level of confidence that we are at the beginning of a bull market, that we have seen the price helpfully bottom last year. And from an investor perspective, it's that golden age of any commodity when you know it's turned, it's on an upward trajectory, but the competition hasn't piled in and moved prices yet.
Excellent. Okay, as we begin to wrap up the show today, Brandon, is there anything else you'd like to talk about or anything else on your mind at the moment?
Well, I think it's talked about a lot, which is Section 232. I think there's one thing that seems to be missed in the discussion and the equation. Much of the discussion about Section 232 has been speculation about who are going to be the winners, which tends to be the view that it will be the US producers or potential producers of uranium if the Trump administration grants them what they wish, and who will be the losers, which will be the rest of the world. The rest of the world producers, that is. But, Kerem, I just don't buy that. I've done a lot of analysis. I've done a deep dive scenario plan on more than a dozen potential outcomes from Section 232, from a 25% quota to a 15 quota to a 10 quota to a quota that includes allies to tariffs to some other more interesting things that the Trump administration might do to address some of the issues that the nuclear power industry is facing in the US. I don't find a single scenario there that doesn't lead to a uranium price going up. Now, sure, there'll be winners and there'll be super winners. And for example, if the Trump administration does grant the petitioners their wish and we see a 25% quota, the existing US uranium producers will be super winners. But investors seem to be holding off because they've forgotten that the whole sector's been suppressed for about 18 months. There's been this cloud of uncertainty that's been obscuring everyone's vision for 18 months now. And the pure act of lifting that uncertainty through a resolution of Section 232, no matter what that is, or if it's even nothing, if there's no action, once that uncertainty is lifted, it will lead to an increase in activity in the sector. And given all of the fundamentals behind it, it's my strong, high conviction view that it will lead to an increase in prices. And that's being missed by the sector. And if your listeners only take that from this interview, then I think that'll be a good thing for everyone.
Fantastic. Okay, well, thank you very much for your time today, Brandon. I'm sure we'll have you back on the show again later in the year.
I'll look forward to that. Thanks again, Kerem.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?